The Shanghai Futures Exchange just reopened after a 2-week Lunar New Year silence. And what is happening inside that market right now may be the most consequential story in global commodities that almost nobody in American financial media is covering properly. This is not a story about a silver price tick. This is not a story about one man's bad trade. This is a story about a billionaire sitting on the most dangerous short position in the silver market in decades, an exchange that just rewrote the rules while he was holding that position, and a supply crisis underneath all of it that directly threatens American manufacturing, American clean energy infrastructure, and American national security. Let me walk you through this, layer by layer, because the full picture is stunning. Start with the man at the center of it. His name is Billionaire. If you have not heard of him, that is by design. Bloomberg describes him as someone who avoids the limelight and spends much of his time in Gibraltar, which is a long way from Shanghai. But for the past 2 years, Billionaire has been the most watched trader on the Shanghai Futures Exchange. In 2024 and into 2025, he built the largest net long position in gold on the SHFE and rode that trade all the way to nearly $3 billion in profit. $3 billion. From a single commodity bet. That is not a typo. Bloomberg confirmed those numbers in February 2026, as did Fortune magazine. Billionaire became, almost overnight, the most celebrated commodity speculator in China. Pay attention to this next part, because this is where the story pivots. After banking those gold profits, Billionaire made a decision. He looked at silver, which had surged more than 130% in 2025 alone, according to JP Morgan, and he decided it was overpriced. He decided the rally was going to collapse, and so he built a short position. Not a modest hedge, not a cautious bet, a naked short position of approximately 450 metric tons of silver, structured as 30,000 contracts on the Shanghai Futures Exchange. Investing.com and Binance both reported those figures. The position was valued at roughly $300 million. It is the largest single net short position in silver on the SHFE. And here is where it gets dangerous. When analysts cross-referenced Billionaire's 450-ton short against the total silver inventory sitting in SHFE warehouses at the same moment, the number they found was 318 metric tons. Let that sink in. Billionaire has shorted more silver than physically exists in the exchange's warehouses. His position exceeds 130% of the deliverable supply. That is not a trade. That is a structural problem. Think about what a short position actually means at the mechanical level. When you short a futures contract, you are making a promise. You are promising to deliver the underlying asset at a set price by a set date. If the price falls, you profit. But if the price goes up, and if you cannot deliver the physical metal you promised to deliver, you have to buy it in the open market at whatever price is being asked, and you have to buy it right now regardless of cost. That is called a short squeeze. It is the same dynamic that obliterated a number of hedge funds during the GameStop episode in 2021, except this is silver. This is a physical commodity with real industrial applications, and the man on the wrong side of it controls a position bigger than the entire warehouse. Here's what nobody is talking about. The SHFE already saw this coming. 2 weeks before the Lunar New Year holiday on February 9th, 2026, the exchange moved quietly but decisively. It raised the financial margin requirements for holding silver positions. That was the first warning shot. Then, in a move that market analysts have been describing as extraordinary, the Shanghai Futures Exchange announced a new rule effective February 27, 2026, just days after reopening. The rule is this: hedging positions in the delivery month and the month immediately before delivery are automatically reduced to 0 contracts. Automatically. No grace period, no negotiation, 0. Analysts writing on LinkedIn and in specialist publications have described this as the exchange effectively declaring war on paper, silver positions that have no physical backing. Think about what this means for Billionaire specifically. He is holding 30,000 contracts. The exchange just announced that in the delivery months, those contracts compress towards 0 by rule. That means he either finds 450 metric tons of physical silver to deliver against his position, or he has to buy back his short in a market that is already in backwardation. Backwardation means the near-term price of silver is higher than the future price, which is the market's way of screaming that physical metal right now is more valuable than a promise to deliver later. The SHFE has been showing backwardation for much of 2026, according to Bloomberg. Let me put a number on what closing this position could look like. At silver's current price of around $90 per ounce as of February 25, 2026, 450 metric tons is approximately 14.5 million troy ounces. At $90 per ounce, buying that silver in the open market to cover costs roughly $1.3 billion. He paid somewhere around $300 million to open the short. The mathematics of being wrong here are catastrophic. But step back from beyond seeming for a moment, because the individual trader story, as dramatic as it is actually the smaller story. The bigger story is what his predicament reveals about the state of the global silver market, and specifically what it means for the United States. Here is where it gets dangerous for American industry. China controls somewhere between 60 and 70% of the world's silver refining capacity. This is not a contested figure. Phoenix Refining, the Korea Jungang Daily, the Silver Institute, and multiple commodity research houses have all reported figures in this range. What that means in practice is that even if silver is mined in Mexico, Peru, or the United States, a very large share of it gets refined in China before it enters global supply chains. China is not just a consumer of silver. China is the bottleneck through which most of the world's investable, deliverable silver flows. And on January 1st, 2026, China changed the rules of that bottleneck. Effective the first day of this year, Beijing implemented a new export licensing framework for silver. Under this framework, only 44 specifically approved companies are permitted to export silver. According to Reuters, the Chinese government published this list on December 30th, 2025. CNBC described it as China echoing its own rare earth playbook, referencing the series of export controls Beijing used on rare earth elements to demonstrate that it could weaponize critical mineral supply as a geopolitical instrument. Morningstar's Market Watch column was blunt about the implication, writing in January 2026 that China is using silver as an economic weapon. Now consider the United States' position in this picture. U.S. mines produced approximately 1,100 metric tons of silver in 2025, according to USGS data. But American consumption vastly exceeds that figure. The Silver Institute estimated the global market deficit at roughly 120 million ounces in 2025, the fifth consecutive year of supply shortfall. The United States is a net importer, and the country it most depends on for the refined product it needs is now the same country restricting export licenses. This is not speculative. The USGS itself published its Mineral Commodity Summaries 2025 and 2026, and the data is there in black and white. According to the National Mining Association's analysis of those USGS reports, in 2025 the United States was 100% net import reliant for 16 minerals, and China remained the dominant source for supply of 21 non-fuel mineral commodities, where the U.S. depends on imports for more than half its consumption. Silver was added to the official U.S. critical minerals list in 2025. The Department of the Interior finalized that designation, adding silver alongside copper, boron, and uranium. The government's own assessment is that this metal is now a matter of national security. Think about why that designation matters. Silver is not just in jewelry and coins. Every solar panel manufactured today contains silver paste in its photovoltaic cells. It is the most electrically conductive material known, and there is currently no commercially viable substitute at scale. Every smartphone contains silver. Every semiconductor package contains silver. Military radar systems, missile guidance systems, and satellite components all depend on silver. When the Solar Energy Industries Association talks about the manufacturing cost of photovoltaics rising, silver price is a central variable in that equation. When the solar industry hit headwinds in early 2026 and began exploring the shift from silver to copper electrodes, analysts at companies like Bluesmith Solar and Vioxx noted that the transition is years away from commercial viability at scale. The dependency is structural right now, not theoretical. Here is what nobody is talking about. The COMEX, which is the primary silver futures exchange in the United States and the pricing benchmark for silver globally, is experiencing its own inventory crisis in parallel. Total registered silver at the COMEX fell below 100 million ounces in February 2026. Before you ask whether that is normal, consider this context. As of February 20th, 2026, total COMEX silver inventory stood at approximately 366 million ounces, down nearly 31% from roughly 532 million ounces in October 2025. That is a drain of over 160 million ounces in roughly 4 months. CoinWeek and LiveMint both reported these figures. In the first week of January 2026 alone, COMEX warehouses saw a 33 million ounce withdrawal in 7 days, representing 20 higher than historical averages. What that tells you, as a student of market structure, is that the people holding paper silver contracts are increasingly demanding the actual metal. They no longer trust that the promise of future delivery is good enough. They want the bar in their hand. That is a profound shift in market psychology, and it is happening simultaneously with the inventory drawdown, with China's export licensing restrictions, with the SHFE rule changes, and with a Chinese billionaire holding a naked short position he may not be able to cover. Pay attention to this next part, because this is the convergence point. When Shanghai reopened on February 24, 2026 after the holiday break, silver was trading at $87.87 per ounce, according to Fortune's real-time market data. By February 25th, it had moved to $90.88, a rise of over 4% in a single session. The FX Leaders market analysis team noted that silver markets calmed somewhat after the turbulent period preceding the holiday, but that China's supply tightness persisted. The backwardation in the Shanghai market, meaning near-term contracts priced above longer-dated ones, signaled continued physical strain. Now layer in the February 27th rule change deadline. BN Shiming has a position of 30,000 contracts. Those contracts must be reduced by rule in the delivery months. He is operating with a timeline. He does not have the luxury of waiting for silver to drop before he covers. The exchange has told him his time is up regardless of price. This is the definition of a trapped position. The question that serious market analysts have been asking is whether the CCP itself steps in. The site Silver Trade published an analysis noting that CCP intervention in BN's position could actually supercharge the next leg of the silver bull market. Because if Beijing forces a liquidation of his short through a structured mechanism, the short covering alone could send violent price shocks through both the SHFE and the COMEX simultaneously. Remember, these two markets are now more tightly linked than at any point in recent history, precisely because the global physical supply is so tight that arbitrage flows between New York and Shanghai have become a dominant market force. There is an important historical parallel worth examining here. In 1979 and 1980, the Hunt brothers of Texas attempted to corner the silver market. Nelson Bunker Hunt and William Herbert Hunt accumulated roughly 100 million troy ounces of silver, equivalent at peak prices to somewhere around $10 billion in today's terms. When the exchanges changed their own margin rules to break the trade, silver collapsed from nearly $50 an ounce to under $11 in a matter of weeks. The Hunts were ruined. The CFTC and the SEC investigated. The episode became a textbook case in commodity market regulation and the limits of concentrated speculative positions. BN Shiming's situation has structural similarities, but with one critical difference. The Hunts were long a commodity they were trying to hoard and squeeze. Bian is short a commodity he does not possess in a market that is already running out of deliverable supply. The direction of the potential catastrophic outcome is entirely reversed. If the Hunt scenario was a reminder of what happens when you try to own everything, Bian's situation is a case study in what happens when you bet against scarcity in a market that is genuinely scarce. This is bigger than one trade. Because beneath Bian's position, beneath the SHFE rule changes, beneath the COMEX drawdown, is a structural reality that the Silver Institute has been documenting for 5 consecutive years. The global silver market has run a supply deficit every single year since 2021. Total deficit across those 5 years, approximately 820 million ounces, according to Crux Investors analysis citing Silver Institute data. Demand from solar panels alone has been growing at double-digit rates. Demand from electric vehicles and the wider electronics sector is compounding on top of that. But mine supply has been essentially flat, growing only 2% year-over-year globally in 2025. You cannot have 5 consecutive years of consuming more silver than you mine without the physical consequences eventually showing up. And they are showing up right now, in real time, in the COMEX warehouse numbers, in the backwardation on the SHFE, in the drain of registered stocks, and in the scramble by industrial users to secure long-term supply contracts. What does this mean for the United States specifically? Morningstar's analysis captured it directly. China has figured out something Washington is still processing. The clean energy transition, the semiconductor build-out, the defense modernization agenda, all of it runs on silver. And the nation that controls silver refining, that has now weaponized export licensing, and that is watching its own physical inventories drain, has structural leverage over every country that depends on its refined product. The U.S. is one of those countries. When the USGS formally designated silver a critical mineral in 2025, it triggered a set of policy responses under the Energy Act of 2020. That designation allows federal agencies to prioritize supply chain development, streamline permitting for domestic silver projects, and in theory, coordinate a strategic reserve buildup. The designation is not just symbolic. The question is whether the policy apparatus moves fast enough to matter in a supply environment that is deteriorating in real time. Here is what you need to watch for in the coming days. The February 27th SHFE rule change is the immediate trigger. Watch whether Beyond Shiming's position data on the exchange shows a reduction in net short contracts in the days that follow. If the position begins to close, watch the silver spot price on both COMEX and the SHFE for the resulting short covering rally. Watch the COMEX registered inventory numbers, which are published daily. If they continue falling from the current 366 million ounce level at the pace of the past 4 months, the market structure becomes increasingly fragile. Watch whether Beijing uses the export licensing framework as a negotiating instrument in the ongoing U.S.-China trade dispute, given that silver is now formally a U.S. critical mineral and China controls the refining choke point. And watch the solar manufacturing sector's cost statements in their next quarterly earnings, because a silver price above $90 per ounce is already beginning to restructure capital allocation decisions in photovoltaic manufacturing. This is a story about market structure, about geopolitical leverage, about what happens when a speculator makes a bet that the laws of supply and demand will bend to his conviction, and about what it means for an industrial superpower when a rival controls the refining capacity for a metal that is now officially classified as a matter of national security. The facts are the story. Beyond Shiming shorted 130% of available SHFE warehouse silver. The exchange changed the rules on him 3 days after it reopened. COMEX inventories have fallen 31% in 4 months. China controls 60 to 70% of global refining and just put 44 gatekeepers on its exports. The U.S. designated silver a critical mineral and still depends on imports for a major share of its refined supply. The global market has run 5 consecutive years of structural deficit. None of that requires embellishment. None of it requires a villain. The structural forces at work here are larger than any individual actor, including Beyond Shiming. But his position, sitting at the intersection of all of these pressures as Shanghai reopens tonight, makes him the most visible person at risk when these forces collide. Stay informed. Watch what happens next with SHFE position data, COMEX inventory levels, and China's export licensing policy. The silver market in 2026 is moving faster than at any point since the Hunt brothers tried to squeeze it in 1980, and this time the squeeze is coming from the supply side, not from a couple of Texas oilmen with futures contracts. The consequences for American industry are real, they are quantifiable, and they are still unfolding.